primary thing, and I'm always big on communication. The primary thing to me when looking at a mortgage lender is having direct access to the guy.
And so for somebody to try to time the market or wait for interest rates to come down, you're doing yourself a disservice.
Especially with the rates where they're at, stuff like that, the economy where it's at. What are some of the biggest challenges you see on a regular basis?
This is the Just One More podcast starring Chris Jacobs and Carlos Kopszywa.
Welcome to episode 7 of the Just One More podcast. I am Chris Jacobs.
You just said 8, like 1 second ago.
No, it's episode 7.
Okay.
This is Carlos Kopszywa, by the way.
Hey, I'm Carlos.
And this is the man, the myth, the legend, Josh Martinez, the beautiful Josh Martinez with Homeward Mortgage, one of our the premier mortgage partner for the Neil and Neil team at Keller Williams. And we are coming to you wounded very badly. We had a fantastic team event yesterday with Zillow with some fantastic information coming down the pipeline for our clients. And it bled over into a very interesting long night, but it was worth it. For the most part, it was. So Josh, how we do these things, pretty typical podcast. Actually, it's not typical at all because we don't know what the hell we're doing. We just kind of fly by the seat of our pants. So if you want to introduce yourself, tell everybody who you are, what you do, and why you do it, and we'll get started from there.
Cool. Yeah, no, I appreciate you guys having me on. So I'm Josh Martinez. I'm with Homeward Mortgage here in San Antonio. We're actually based out of Austin, but work locally here in San Antonio, do some business in Austin as well. Been in the business for, going on, 9 years now, 2024. Yeah, going on 9, at least in the mortgage business. I started off in the real estate business, got my license in 2011, did that for almost 5 years. But yeah, man, crazy to think about, like I said, in the mortgage business for almost 9 years now.
What kind of made you transition from real estate into the mortgage world? And like I said, you were, how long were you a realtor for?
So almost 5 years.
So 5 years. What made you decide, you know what, I want to go on that side? How did that transition or journey take place?
Yeah, no, for sure. I mean, I think like most of us, right? None of us really intended in getting into real estate. So it was the same thing for me. Just wanted to do something with business. And then really, so I studied finance in college. That's what I was studying, and had no like clear path forward in terms of what type of business, finance, nothing like that. So got into real estate, was referred by a good friend of mine that was in real estate for years. So I got into the business, and then obviously got to learn the business, and then found out, what mortgage was about, and just kind of felt like it was a little bit of a better fit. So did some research for quite some time before I ever made the transition. But yeah, that was it would have been the end of 2015, I think, is when I got my license, and then started making the full-time transition. So by 2014, 2014, 2015, I was full-time in the mortgage business. So it was really honestly just more matter of preference, kind of found it was a little bit of a better fit. Definitely wanted to, at that point, being in the real estate business, like I said, for almost 5 years, I knew that I wanted to stay in the business, didn't want to venture too far off. So, went into mortgage and
now you're doing it. Now you're doing it to it. And I know you're a big, I guess, time part of our business here at the Neil and Neil team. So when you jumped into mortgage, how long did it take you, one, to meet the team or start working with the team, and how did that transpire over time?
Yeah, for sure. So, I mean, I think like most, right, things started to evolve in the mortgage business, really in the real estate business as a whole. So, I mean, when I got in 2011, obviously the Neil team, right, didn't even exist at that point either. So as things started to evolve in the real estate market, in the real estate business, things were slowly starting to transition to teams. And so as I started to watch that happen in the real estate world, I pretty much knew that that's kind of where I wanted to switch my business as well. I mean, it just made most sense, right? 20 versus working with 20 different realtors, getting to work with the team who typically they're going to work with the same systems, same processes, right? Same mindset, things like that. So that's kind of where my mindset was already going. And I was like, all right, got to start, kind of just exploring different options. And so honestly, the connection just kind of happened by accident or by chance. And so I was already in the mortgage business, of course. I'd referred actually a family friend of mine to a real estate agent that I was friends with. And so Shane was actually the listing agent on that transaction. Went super smooth. Super smooth transaction. I think they had already added some of the mortgage facet to their team had been doing it for a few months, about a year, something like that. But yeah, that transaction went pretty smooth. And so I connected with them. We just started a conversation, started talking for about 6 months. And then they just said, hey, why don't you, come on board? Want to start a partnership. And so, one thing led to another. And like I said, it was probably about a good 5 to 6 months before we ever partnered up on, just the mortgage facet of it. But yeah, it's again, just kind of came to be through a transaction. So
When you joined the team, you joined under a different mortgage company back then. I think it was Willow Bend.
Willow Bend, yeah.
Willow Bend.
yeah.
Are they still around?
I don't think so.
I don't even know,
I don't
to be
even
honest.
know. Yeah,
That literally never heard of
that was a
them.
while ago. Now you're with Homeward, and something that I've always known in my years in real estate is you're better off going with the mortgage brokerage types that can shop it versus big banks. Explain to people what is the difference between going through like a Homeward, a mortgage broker, so to speak, versus going to Randolph Brooks or PenFed or something like that.
Yeah, for sure. So there's definitely a pretty big difference, right? So you have your mortgage company, mortgage broker. Those terms are kind of used interchangeably, right, in the industry, but definitely significant differences from going through just a bank, right, or a credit union. So I think where the main differences come in is the cost, right? And so when you think of a bank, you think of banking products. You think of typically high interest type products, right? You're thinking car loans, you're thinking credit cards, lines of credit, things of that nature, right? So that's obviously how banks make their money. That's how they operate, right? A mortgage company, obviously, I mean, we offer one product, and that's a mortgage. Now there's going to be different varieties, right? Different entities, VA loans, FHA loans, things of that nature, right? But we're focused on one thing is mortgages, right? And so when it comes to a cost perspective, right, we can cut costs because that's the only thing that we're offering, right? And so everything from start to finish with all our people that we have on board, right, we're focused on one product. Whereas with the bank, credit union, right, you have people that work in all these variety of different departments, right? You have the insurance department, you have the, again, auto loan department, right? So you have just a lot of different products that they offer. And so there definitely is benefits, specifically with Homeward Mortgage. We are set up more of a broker style type shop, right? And all that simply means in the real estate world is that we offer options, right? So same thing, some mortgage companies only offer one option. So if I go shop with ABC Mortgage and they only have, let's say, one investor per se, then I'm going to be open, or the only option I'm going to have is one rate option, right? And that's all I'm going to be able to shop with, or to get from that company. Same thing with the bank, right? I go to the bank, I go to Chase, Bank of America, they have one rate option. That's the only option that they have. Homeward Mortgage, again, we're set up a little bit different. We operate like a broker. So we have over 15 different investors that we work with. We've obviously hand selected these investors, right? And they're the top investors across the nation, best margins, best pricing, best interest rates. So when you come to me and you apply, I'm going to look at your profile. I'm going to look at what loan you qualify for, credit, all that good stuff, right? And I'm going to go do the shopping for you so that once you go under contract and you're ready to lock in an interest rate, we are by far finding you the best interest rate that's out there. So super obviously beneficial, right? It's a one-stop shop essentially is what we're talking about.
But see, and the cool thing about I think the primary thing, and I'm always big on communication, the primary thing to me when looking at a mortgage lender is having direct access to the guy, because you find yourself chasing people when you're going with the RBFCUs. I mean, you look at USA's model, it collapsed because it was so inefficient. And I know they were always talking about, they're military. They were never military friendly, in my opinion. But
you got to talk to like 30 people.
Yeah, just to get to find out where the hell your loan is. And that's the idea of a broker, a mortgage broker like Homeward, like Josh, is you're calling him. He's the guy. He finds out everything you need to know. To me, that's the benefit, the main benefit. But when you get into the terms, the programs, the different options to purchase, y'all are a lot more flexible because you have several different investors. But explain to people, because I think people fail to understand what a mortgage broker is and what an investor is, because you have your primary market, your secondary market. When you say investors, you mean secondary market, the people that are going to service the loan more likely than not. So explain to people what that process looks like, how that works.
Yeah, for sure. So in the mortgage world, as Chris was explaining, right, there's what we refer to as investors, right? And so those are basically the people that hold the money, right? So when you come to Homeward Mortgage, we would be what we would refer to as the originating company, right? And so all that means, again, in layman's terms, I'm basically the one that's going to do all the legwork on your mortgage, right? You call me, I'm going to take your application, I'm going to pre-approve you, I'm going to talk to you about what your payment's going to be, what your down payment, what programs you qualify for, right? So all the really front and facing, things that go into a mortgage, right? Getting pre-approved and essentially buying the home, right? So I'm taking you from the time that you start your home shopping all the way to get your keys to your new home, right? So that's going to be Homeward Mortgage. That's going to be myself, right? I'm the person that's essentially driving the bus behind that transaction. An investor, they work behind the scenes. Like I said, they're the ones that hold the money, right? And so when we go to an investor, They're the ones that are providing the funding for the transaction. And essentially, like you mentioned as well, they're the ones that are going to pretty much service that loan. And what that means is they're basically going to be the ones that are going to take your payment. They're going to have the customer service hotline that you're going to call with any questions that you might have. Now, while none of your terms are going to change, right? So if I lock you in today at a 7% rate, you lock it in with Homeward Mortgage, that is going to be your permanent rate. So even though somebody else may be taking your payment for the next 30 years, they have no, they have no ability, right, to change any of your terms or anything like that. So that's really the difference is, like I said, Homeward is the consumer facing facet of the mortgage business or mortgage part of the transaction, if you would. The investor behind the scenes provides the funding. And so that's how the two essentially, work together in the mortgage world.
Yes. Like when you get your mortgage and you start the process of closing, you're going to close with Homeward. And then essentially everybody's noticed this, like 2 months later, you get a letter from some random bank and you're like, who the hell is this?
Yeah.
Penny Mac, Flagstar, whoever.
I'm not paying them.
And you're like, and the first thing they do, I'm sure, is call you. What the hell is this? That's what they're talking about. That loan is going to go to a secondary investor that's going to actually service the loan that you're going to make your payment to, yada, 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 so forth and so on. When you're talking about loan products, you're not just talking about FHA, VA, or conventional. You could be 203B, which is the rehab loan. You even do hard money with Wind River Lending, which we'll get into that here in a little bit. But the VA side of it, there's other programs that y'all work with in terms of, buy downs, buy before you sell. There's so many different options y'all put on the table for a consumer that, let's say you need to sell a home to buy it, but you're like, man, like I really need to line this up before I sell because, maybe my house is going to sell really fast. Y'all have a program that allows you to do something like that, right?
Yep, exactly. Yep. So our company was founded in 2009. The cool thing about our company is it was founded by a real estate agent himself. In fact, Clinton Shane are friends with him. They've known him for years. He's had a really successful real estate team out of Austin, which is where our company is based out of as well. But that guy's just a brainiac. I mean, he's worked very closely with Gary Keller, right? Who is obviously the head guy, right, at Keller Williams.
Does he work here? He works with us?
Kind of.
Oh, okay.
Yeah, so he's worked very closely. Again, he's a brainiac, right? And the cool thing about him, his name's Tim Heil. He has always been very forward thinking, right? Always trying to come up with ways to really just provide solutions for home buyers and home sellers, right? So the product specifically that you mentioned is called our Buy Before You Sell program. That was actually the very first program that he created. That's probably the one that we use most at our company, aside, of course, from our mortgages. But cool thing about Homeward is that we're almost like a full service type company, right? So we have Homeward Inc., which is our parent company, which I'll talk through the program. And then of course we have Homeward Mortgage, which is myself, and then Homeward Title as well. But yeah, Homeward Inc., basically what they do is they provide solutions for clients, again, buying and selling. And so what Buy Before You Sell allows you to do is it allows you to buy your new home prior to you first selling your home, right? And so the typical process is, right, if I have a home to sell, it's going to get kind of crazy, right? I have to figure out and time everything perfectly. I have to figure out, when am I going to list my home? Haven't found anything else. Got to buy something. Got to move kids. Got to move pets. Moving school district. There's just a lot of moving pieces. And so when he created the program, what he was looking to do is basically solve and alleviate the stress that goes behind selling and buying, right? And so when you get approved to use our program, the benefits of the program are that not only are we making you a cash buyer, right? You're going to be able to use our cash to purchase your new home, but there's also going to be no contingencies attached to it. And number three, of course, I think the biggest thing is it alleviates you from having to worry about selling and buying at the same time. So we loan you our cash, you make a cash offer gets accepted, you get to move into your new home, get all situated, get the kids moved in, get your school district all set up, right? Like take care of all the important things that typically go into, moving and buying and selling. And then you get to work with your agent and get your home on the market, get it sold and stuff like that. So it really allows you to handle those two transactions separately, while typically, again, without the use of a program like ours, I mean, you're literally going through both of those, buying and selling at the same time, working with your agent, trying to figure out how to time everything. And it can get really stressful, right? And so that's one of the cool things about just one of our programs, which that, again, is our Buy Before You Sell one. That just, brings a solution to the marketplace. And so it's still growing, it's still evolving. We're obviously still trying to get the word out. We're really direct to agent. We work very closely with our real estate partners. But yeah, that's definitely a big one for us.
But that's not exclusive to the Neil and Neil team. Like you can do that
with
anybody. Okay.
Correct.
I was going to say, I've used the Buy Before You Sell program a couple times, and it's not just beneficial for the buyer, but the seller who house they're buying,
Oh, yeah.
I mean, they get a clean sale, whether the buyer gets approved or not, they're still selling their home. Homeowner's just going to turn around and sell it if that buyer can't get approved. So I feel like for the sellers, super beneficial because I mean, I think I did one and we closed in like, I don't know, 11, 12 days. It was like super quick. And the appraisal came back in like 2 days. I was like, wow, you can do these all the time.
Yeah, we got the process down to a T at this point. I mean, again, we've been doing it for quite some time, and that's the one that we use most frequently at the company. So, yeah, we've definitely fine tuned the process over the years.
I mean, this is a good segue into some of the challenges homeowners face.
Mhm.
So yeah, what are some challenges in today's market that you see a lot of homeowners or home buyers facing, especially with the rates where they're at, stuff like that, the economy where it's at? What are some of the biggest challenges you see on a regular basis?
Yeah, for sure. I mean, aside from things like being in a transition period where you're selling and buying, right? And we talked a little bit about that program. I think right now the biggest challenges that most people are facing, and of course, whether you're buying or selling, right, you're going to be on the buy side at some point in the transaction. I mean, it's just interest rates, right? I mean, I think that's been the biggest thing. I mean, it's all over the headlines,
Mhm.
and I think it's more than that, right? I think a lot of people get fixated a little bit too much, if you would, on the interest rate itself. It's more about the affordability, right? And the reality is, we know that homes appreciated at a astronomical, rate for almost 2.5, 3 years. And so some of the things that we've done is we've obviously rolled out some programs like what's called a 2-1 buy down, which is a temporary buy down that allows you to lock in a lower interest rate. We have a free refinance with our company as well that we've been offering for a year and a half. So there's a variety of different options, programs, things that we created to help alleviate and make sure that the consumer, right, if they want to make a move, has the ability to make a move without putting a strain on their finances or, pretty much just sidelining them altogether, right? Because I mean, I think that's the biggest thing. We have conversations, every day with clients that are just super hesitant, right? Either to get off the fence or just jump into the market altogether. But affordability is definitely, I think, the biggest thing, right? It's unknown at this point, right? In what direction we're headed with rates. I mean, it's looking positive, but I think it's a little bit of unknown. But nonetheless, those are definitely the conversations that we're having, today and been having for the last year and a half is, how can we make somebody, comfortable enough where they can afford a home, afford the payment, and so become a homeowner in this market. So
You said things looking positive.
Mhm.
I mean, you give us a report pretty regularly, but tell everybody that's listening, like, what are you seeing in the market? What are you expecting over the next couple of months? I mean, I've got listings that are sitting, I've got listings that are moving, but a lot of it falls down to interest rates and price. So give us a market update.
Yeah, for sure. So I think it's a little hard, right, to pinpoint.
No, I need you to nail it down exactly.
Man, it's so crazy, right? And it's crazy to think of this. And I mean, I won't go down a rabbit trail on this, but we're talking. I think Carlos and I were talking a while back, and I was talking to some of the other agents. Like, the Federal Reserve literally is a group of people that move the needle for all of us, right? And I mean, I hate to say we all pay the price, but we essentially do, right? I mean, we're paying more interest on. I mean, shoot, just insurance alone, right? I mean, go get car insurance, home insurance. It's just crazy. Everything's so much more expensive nowadays, right? But
Imagine that.
nonetheless, I mean, again, you have this group of people, right? Just to make it simple, called the Federal Reserve. Now, while they don't necessarily dictate mortgage rates, their decisions play into all the other things that go on in the economy, which essentially then result, right, in the movement of mortgage interest rates, whether that's up or down. And so, what I can say at this point is, again, the Federal Reserve has been extremely volatile. I mean, probably more than ever in the last year and a half, right? I mean, literally 1 month they're talking about cutting rates, and then the next month it's like we're raising rates. As of today, and this again can change literally within the next 30 days, but as of today, the direction that we're headed in, inflation is starting to tame a little bit, and obviously that's the biggest thing, right? The Federal Reserve is looking at a variety of different reports that come out on a monthly basis. More importantly, they're looking at where is inflation, right? And how do we tame it? How do we get it back under control? At this point, what we know is at the beginning of the year, they were talking about potentially 3 to 4 interest rate cuts happen in 2024. They've now scaled back. They, in fact, last month had scaled back to maybe only 1. Now there's talks on the table again about 2. When that's going to happen, it's still looking like the latter part of this year, maybe September, October, even, again, really just Q4 could be.
Imagine November.
Yeah.
Something pretty big coming up in November.
So we should
Yeah.
expect rates to be where they're at, or possibly even higher between now and then.
So thankfully today we did get a little bit of a dip. In fact, it dipped from where it had been. So it had been quite high over the last 45 days. About the last week and a half, we saw a good little dip. Still, obviously, not exactly where I think we'd like it to be, or at least where most consumers would like it to be. But what they're going to do for the time being is they're basically going to hold things steady. And then they'll come in and at some point make that decision to finally do a rate cut. What I would anticipate is if there are 2 rate cuts, they'll probably be a quarter of a point each. And honestly, what that's going to result in is pretty good mortgage interest rates. I think we get into the low 6s with government loans. I don't know. I'm trying to stay optimistic. I don't know that we'll get into the high 5s this year. We'll see. But and then of course we'll get conventional and conforming loans hopefully back into the high 6s, potentially mid 6s. But I will say I think if that happens, we're going to definitely see some pretty good traction and some movement. You're talking about some of these stale listings or listings taking a little longer. I think that quarter of a point to half a point this year is definitely going to be enough to move the needle with the consumer. So things are looking pretty good, pretty optimistic. Again, it's literally a month by month decision with this Federal Reserve. They're just all over the place, but I don't know. We'll see. But as of today, and hopefully for the next 30 days, it's looking pretty good.
Well, the plus side is with the market the way it is and the buy down options, you're giving buyers basically the opportunity to buy the rate down 2 points for the first year. And then it goes up 1 point the next year. So if average market rates right now are 6.7, 6.8%, somewhere in that range, you're buying a house for 4.8% for the first year. So at that 4.8%, that's a substantially lower mortgage payment. And then in that first year, if rates drop down to a number you're comfortable with, even if it's the number you're financed at currently, 4.8, you can refinance, and y'all do a no-cost refinance outside of title work, I believe.
No, so we'll cover title as well.
So Homeward will do a no-cost refinance. So no title work, nothing. So basically you refinance for free into that lower rate and you lock it in permanently. If you wait a year, your rent rate will go from say 4.8 to 5.8, and then you'll be 5.8 for that full second year with the opportunity to refinance again, or refinance for the first time into a lower rate. So you're just playing the waiting game to see what the numbers are going to do. Now, when it comes to the third year, you go back to what rate? The rate that it was when you went under contract, or the current federal rate?
No, so it'll be the permanent rate we locked in at the start of the process.
So if you
6.8
if you shit the bed and you wait too long and you miss the boat, you could be locking into a rate that's higher than what the market rate is. So you need to pay attention to that. But that's why it's important for your agent and your mortgage broker to stay in touch with you, keep that line of communication open, because that's going to be really important. But there's another method that I was thinking about a couple of years ago. I posted a video about this, another method to help you save money on your mortgage, especially you guys that have bought really before 2021, 2022, even say some 2023. The rapid rate of appreciation has been tremendous over the last 5 years. I think, average San Antonio appreciation was somewhere between 6 and 8%. I think we saw somewhere between 15 and 16% over the last 4 years or so. So PMI, primary mortgage insurance, correct? That's basically an insurance that y'all carry as a protection in case something goes south with a loan. But if you get over 20% equity, you can waive that. Talk about what that does for a buyer that doesn't know what it is, didn't even know you could do this, because I did it. I refinanced my house. I didn't refinance my house. I applied to remove my PMI last year, a year and a half ago, and it saved me $271 a month on my mortgage. So tell us about PMI and how you can eliminate it and save money on your mortgage.
Yeah, for sure. So we'll talk a little bit about 2 different programs that obviously have PMI. So you have the FHA loan, and then you're going to have the conventional loan, right? So FHA loan, unfortunately, years ago, there was a change. It used to be where you got to a certain percentage, almost like conventional, right? And then you could get it removed out. So unfortunately, FHA or the Department of HUD moved to have private mortgage insurance on the loan for the life of the loan, right? In addition to that, there's also what's called upfront mortgage insurance. So definitely, FHA is definitely a good program, for the first-time home buyer who's maybe low on capital, right, buying their first home. So it's definitely a good avenue to get into home ownership. I would say, though, that it's definitely not the program you want to be in for the next 30 years, right, or as long as you intend on holding that home. And so with mortgage insurance, again, if you start off in an FHA loan, the goal is going to be to build your equity, right, and either one of 2 things. Either you're going to refinance if you intend on staying in that home, and we're going to get you into conventional loan, or you're going to go sell that property. You're going to take that equity, use it as a down payment, and then we get you into conventional loan, right? Now, how it's going to work is once you're in a conventional loan, as you mentioned, once you've reached or paid off 20% of that equity, if you didn't, or sorry, principal balance, if you didn't start off with a 20% down payment, you can then go ahead and request that private mortgage insurance. Like you mentioned, it can be a few $100 a month, right? The way it works logistically without all the fine detail is we basically look at somebody's profile. We assess the risk, right? So we're looking at your credit score. We're looking at how good your credit history is. And then we're also looking at what percentage and amount that you're financing, right? So if you're financing $600,000-$700,000, it's going to be a little higher, right? Because you're a little bit of a higher risk. But if you're coming in with a good down payment, you have solid credit, your mortgage insurance is going to be pretty low, right? Nonetheless, I mean, it's still a component of your monthly payment that if you can eliminate, I mean, it's obviously going to save you quite a few $100. So I think that also just kind of leads to the biggest thing that, you know, we always stress is having good credit, right? Maintain your credit, get it up if you don't, because in the long run, all these different components that go into a mortgage, like private mortgage insurance, is going to affect you, right? It's just money that you're throwing away by, you know, having that lower credit score. But yeah, if you get to that point, I highly encourage you. If you're a homeowner now, right, watching this podcast, and you haven't, you just either forgot or you didn't know, and you're in a conventional loan, or even if you're in an FHA and you're like, man, I'm paying $300 in PMI, right? Definitely look into it. It's worth it. Get with the servicing company that holds your mortgage now, and definitely look into how you can eliminate that. Especially if you've had your home for quite some time, like you mentioned, appreciation, right? I mean, it's almost more likely than not that you have that equity built into your home now, where you can eliminate that mortgage insurance and save yourself.
Yeah. I mean, I picked up almost 24% in value from 2020 to 2023.
Mm-hmm.
And so when I went in, I didn't even think about it. Like, I'm a realtor, I should know this stuff. I didn't think about it. So I ran comps on my house. And I was like, holy cow, my house is worth so much. It's like, but I only owe so much. Like, so I called my bank or my lender, I think it was Flagstar. I was like, hey, here's the situation. What can I do? They're like, oh yeah, you got to pay for an appraisal. They'll order an appraisal. Appraiser came out, appraised my house. Like, oh yeah, you're good. Within 60 days, they dropped that $270 off my payment. I was like, holy cow. Like, I mean, that's a big thing to like even offset like the increases in property taxes, which we're going to get into. Like, you see your property taxes increase by $150 a month, $200 a month. Well, if you get rid of your PMI, you kind of offset that. So you can absorb it a little. It's easier to swallow, I guess. But it's definitely something to pay attention to. And the best way to do that is call your realtor, have them run comps on your house, have them put hard numbers on your house. So you can say, okay, my house is worth this much. I owe this much. There's more than a 20% difference, 20% or more. Call your lender, call the servicing company and say, hey, yeah, I want to look into this. Now, I had heard some kickback from some people saying that some lenders will not allow them to waive it on conventional. Is that something they can do? Or is that across the board, you should be able to do that?
No, yeah, you should definitely be able to do that. Yeah. So when you go to closing, there's going to be a disclosure form, right? And it's specifically going to talk about how private mortgage insurance works and then what the parameters or I guess steps, if you would, right, to get that requested and removed. So no, it's all built into your closing documents whenever you sign. So I think I've heard the same, right? There's some servicers out there that exist that will kind of push back. And, you know, obviously, I mean, I guess the reasoning behind it, right, is that depending on where you're at, in terms of your mortgage and how many years you paid into it, right? They're hesitant to want to take that risk of not having that mortgage insurance in place. But nonetheless, I mean, from a legal standpoint, I mean, again, it's built into your loan disclosures. So definitely go back either to your loan disclosures or make sure that you're just pushing on them because it is something that they have to obviously abide by.
Speaking of saving money on loans, I got a question. It wasn't on here, but popped in my head. I hear a lot about IRRRLs with the VA. Do you guys do IRRRLs? And should we not talk about those?
I don't even know what the hell an IRRRL is. I know that there's a song about killing an IRRRL.
Right, it's called IRRRL. IIRL.
Yeah, so essentially the VA version of a refinance.
Oh, that's all that it is?
Mm-hmm. Yeah.
So there's nothing special about it, I guess you could say? Or
yeah. So the cool thing about a VA refinance is, I mean, it's by far the easiest loan program that exists. So cool thing about a VA refinance is we don't have to run credit. We don't have to verify employment. And we also don't have to order an appraisal. So you literally you'll state what that appraised value is on that property within reason, of course, right? Yeah, I mean, it's literally by far the easiest refinance that we do. So,
and with the rates, as far as with IRRRLs, they're just with the standard market rate. So it would be
so it is going to
dumb
be
to do it right now.
Pretty standard. Yeah, for sure. And unless you bought like years. I mean, we're talking.
Unless
years
you got like a
ago.
10% rate or something.
Yeah,
So
exactly. But at this point, I mean, I'm sure you went through that whole, 3% rate, right? So if you didn't refinance then.
Yeah, I didn't even go VA when I built my house. I went conventional. I already had the money in a CD as the builder was building anyways. It's like, and my rate was like 2.1%. I'll never
dumb.
refinance ever.
I should have refinanced, but I was like, yeah, rates will stay like that. I was one of those guys.
What line of work are you in?
I mean, no, this is yeah.
Yeah.
But ultimately, I mean, I have a 4%, so it's not bad.
No, ain't bad.
But I was like, I'm gonna wait. Like, and I thought it would stay in the threes a little bit longer, but then now I'll probably never get a 3.
Well, and if you look at it, like, even though interest rates are 6.5%, 7%, you've been in the business 9 years. I've been in the business 7 years. You've been in the business 30 something years.
Yeah.
But
I was born.
we're probably not far off what the average rate that you've seen.
No,
Oh, no.
it's on
I mean,
pace for sure.
So I think everybody panics because they're, they saw 2%, they saw 2.5%, 3%. Like, oh my God, your rates aren't that much different than what they were 8, 9, 7 years ago. I mean, 6, 5.5. I mean, we're talking a point, so we're talking a couple $100 a month, but it really hasn't. I mean, the rates are high. Don't get me wrong; it's uncomfortable, but I think it's kind of, to me, it stabilized the market. It kind of pulled the reins back. All right, let's stop overpaying. Let's start getting. And a lot of people have this inkling that the market's going to crash. The market is not going to crash. It's not going to crash. Matter of fact, it's probably as stable as I've ever seen it, even through 21 and 22. It's just not as insane, but we're not in the mortgage market is so well protected versus what it was in 2008 because the appraisals, the AMCs, the AMC is an appraisal management company. So there are so many protections for the consumer to prevent them from if you're doing your stuff right, from foreclosing. Because a lot of people think, well, all these people are making a run on these houses and they overpaid and Well, if you overpaid on a house, it was cash because the house still had to appraise and the lender is only going to loan on so much of that percentage of the sales price. So if you went over, you paid cash. So that's on you for doing that. So the mortgage market is so much more protected. Is it fair? Is it, you can get into the politics of it, but in terms of protecting it from the banks failing, I don't know that there's any more that you can do to protect it. I mean, it's so insulated. So the market's not going to crash. We're not going to see are we seeing more foreclosures? Yeah, but they're not because people paid $50,000 over list price. That was cash. They're still financing what a normal finance would be. So the foreclosures you're seeing are people that are losing their jobs, things like that. It's not because the mortgage market is screwing everybody to try to get these houses. Like, they don't want these houses. They do not want the liability of these houses. So that's certainly not a thing that's happening, which is a good segue into the last question about mortgages. What is your market prediction for the real estate market here in the next year or two? Like, what do you see? I mean, I know what I see. I know what Carlos sees. Well, I don't know if really knows what Carlos sees. What are you seeing? What do you think is going to happen over the next 1 or 2 years?
No, for sure. I mean, I'll be honest with you. I mean, without getting into the politics of things, I think the reality is that I think the worst is behind us right now. I think, unfortunately, we are living through some of that, just ramifications, right, of some of the decisions that were made. And I think that's, you mentioned a good point too, right? I think one of the things that most of the consumers didn't realize is that, right, what we went through during the COVID years in terms of just from an economic standpoint, right, the mortgage rates were very artificial and it was done purposely, right? It was done intentionally because what we didn't want is we didn't want to have an economic collapse. And it's interesting to see those years because real estate really kind of was the driving force behind the economy, right? With everything that was happening. And sure, I mean, there's obviously so many other things, right? People overpaying and just all the craziness. But the reality is, right, that again, mortgage rates were very artificial. It was done purposely, but nonetheless, I mean, it really drove the economy through those years with all the uncertainty, right, of knowing what was going to happen. And then, of course, we finally, come out of it and all that stuff.
Did we?
Well, and it's a good.
We need some more of those checks, some of those Trump checks.
Oh boy.
Yeah, but yeah, it's gonna be interesting to see. And I mean, we won't get into politics of it, but the reality is, I mean, we're in an election year, right? And I think that we've had some really hard 4 years, at least from an economic standpoint, and just how expensive everything is. I mean, I don't care what side of the aisle you're on, right? There's without a doubt I think the one thing we can agree on is that everything's more expensive, right?
Oh yeah.
And without, again, going on a rabbit trail in terms of just the way economics works and how that all bleeds into our daily life, the reality is, in terms of the real estate world, right? Things are, like you said, things are not crashing. Things are strong. Things are insulated. I mean, like us in the industry, we always complain because we feel like, man, things are over-regulated, but rightfully so, right? We're here to protect the consumer. We want to do right by the buyer and the seller. But I think honestly, moving forward, it can only get better. Again, we'll see what happens in November, but I'm super optimistic. I think the outlook is super optimistic. I think that, of course, rates do come down at some point. Again, it's hard to pinpoint, but I think we'll see some of that happen towards the latter part of this year. I think 25, 26 are going to be great years. I think that the economy is going to, get back to a really strong, good place, in the next year or two. And so, yeah, on the other side too, and I'll kind of, close with this point on this topic here is just, I can't stress enough, to home buyers, especially if you're watching this podcast and you're on the fence about buying, right? I always tell everybody the one thing that you'll never outpace is going to be the rate of appreciation, right? Rates are going to come down, but it's going to be gradual, right? It's going to be very gradual. And so for somebody to try to time the market or wait for interest rates to come down, you're doing yourself a disservice. And your realtors will tell you, right? Appreciation, like you mentioned, conservatively in the San Antonio market and in Texas in general, has always been about 7+%. And so when you do the math, you will literally be paying $20,000, $30,000 more for a home 12 years from now, while you're sitting back waiting for those mortgage rates to come down. It's just never going to work itself out, right? So if you're on the fence, you're thinking about buying, you're waiting for the elections, you're whatever you're waiting for, I can't stress to you enough that it is always the right time to buy a home, regardless of what rates look like. Don't get so fixated on that. Like, we've talked about a variety of different programs to help you become a homeowner today. That's really where you want to focus at, is finding solutions and finding people that you can work with, right, that are going to help present those solutions for you. So
What he's telling you, Uncle Bob, at the Thanksgiving dinner table, shut the hell up. You don't know what you're talking about. It's a common phrase used in real estate: date the rate, marry the house. I think it's stupid, but it makes sense. At the end of the day, whatever you pay on your mortgage, if you get an affordable home that you're not overpaying for, is going to be cheaper than rent. Period. End of discussion. I don't care what anybody says. Get the 3.5% down. Use the down payment programs, the assistance programs if you need to. First-time home buyer programs. Stop renting. That comes from someone that owns rentals. But at the end of the day, I've owned a house since I was 22 or so. I haven't rented since then. I've turned them into rentals and I've flipped them. But at the end of the day, like, I've never had to pay what market rental rate is. I mean, even when I did rent, it was a hookup deal from a friend, but still, like, figure out a way to buy a house. And I don't care if you use me or Carlos or Jen or whoever, like, buy a house. Like, don't worry about the rate. We'll find programs to get you lower rates. If your agent isn't trying to tell you, hey, there's a program to get you a lower rate, and they're just saying, okay, right on, fire that agent today and call someone that knows the hell they're talking about, because there's so many ways to get lower rates, especially looking at the projections of what this market's going to be. I go back to what I've said for over a year now. 2024 is going to be the hardest year, only because it's going to be an election year. There's going to be so much tension, so much hostility towards the political side of it, that it's going to impact the marketplace. And that's exactly what you're seeing. You're seeing the political side of the aisle impact the marketplace, and not on the rate side, but on the social media, the media networks trying to tell you that this is a bad time. It's not a bad time. I mean, home buyers are tired of sitting on the fence now. They're already coming out of the woodworks. We're getting, hundreds of leads a month for buyers that are like, let's just get this over with. So talk to someone that knows what the hell they're talking about. I tell people all the time, like, more often than not, I'd rather you talk to a lender before you even call me. Know what your options are. But buyers don't necessarily know that. So they call the first person they know, their Aunt Judy, who's been an agent for 47 years. And the problem is Aunt Judy hasn't sold a house in 27 of those years. She's not up to speed on what to do. Find a lender, call them, see what options are out there to get a lower rate. After kind of going over a lot of mortgage stuff, we like to kind of mix it up a little bit. We don't want it just to be a real estate podcast, although it's a freaking real estate podcast. Carlos has a topic that's extremely intriguing to me because it feeds into a topic that I want to cover that goes back into a little bit of the real estate side. What were you talking about with this Kansas City thing?
So back in April, I don't know if you ever really took a look at Kansas City Stadium, and they make fun of their locker rooms. I think Worthy just went over there.
I saw that.
Did you see that?
He walked in the locker room, was like,
he walked in the locker room and says, "Is this a practice facility?" Or because the Longhorns locker room is way better than Kansas City. So Kansas City asked, I think in April, to have money toward redoing their stadium, redoing everything, and they were completely denied for everything. So they're considering moving out of Kansas City, and San Antonio was actually on the list. So I wanted to bring that up to see. I remember we talked on one of the podcasts saying that we really can't support a professional team as Kansas City, even though they're world champions. How would you feel if they came to San Antonio?
No, not going to happen. Not going to happen.
I don't think it would happen either. But I mean, I could see it going to Austin just because how Austin's going. It probably wouldn't happen either, but I think it would go to Austin before San Antonio. But I just think about how much that could bring to the city as far as revenue, people moving here. That would probably make our economy, home prices go through the roof. But what are your thoughts on that?
Jerry Jones and the guy that owns the Texans,
Houston guy?
I can't remember his name.
I
It's
don't
on the tip of my tongue. They'll first of all, they'll never let another team come to Texas.
Okay.
One, you couldn't support a pro football team because there's too many heavy Cowboys fans, heavy Texans fans. It's just never going to work. And if you're listening to this thing and you're on the San Antonio Sports Star Radio, shut up. We tried this in 2005 when the Saints came here after Hurricane Katrina.
Katrina.
Half the Alamo Dome was full. And let's just put it this way. The Alamo Dome doesn't seat a whole lot of people. So no,
Luke Combs
it's
had
never
more
going to
people.
happen. I think the big talk, yeah. I think the big talk right now is potentially moving them across the border into Kansas because they're in Missouri.
Yeah.
Potentially there. They're going to figure a deal out.
Like St.
But
Louis?
this is-
No. St. Louis has Cardinals. No,
Close.
Arizona's Cardinals.
That's Arizona Cardinals.
Yeah.
They moved from St. Louis. This comes down. This really. Tell me what's your thoughts. Do you really think San Antonio could support a pro anything team?
No, at this point, I mean, and you look at the magnitude of player, right, that even the San Antonio Spurs are bringing. Right? I mean, they've obviously struggled for the last few years with a lot of the guys retiring. So, yeah, getting a pro football team again with, I mean, just how big the Cowboy fan base is. I mean, across the country, right?
World.
Yeah,
Mexico.
Sure. So it's I don't see us being able to support a team of that magnitude.
But this comes down to the voters voted on this, right?
Yeah.
Mhm.
And this comes down to property taxes.
Yeah.
That's what it comes down to. And this is a conversation that pisses me off more than anything because the state doesn't do a good enough job explaining property taxes to people. And we dealt with this in Wilson County. You know, the CADs, the appraisal districts became such big enemies because they're so heavy into reevaluating property taxes. This is what it's toward. The property taxes, sales tax like that is going to go towards funding the stadium. People are like, well, I don't want to pay more. We're talking about, if you read the article, 1/3 of a cent
Yeah.
increase.
Mhm.
That's, I mean, come on. And
You wouldn't even
the
notice it.
economical impact of having the world champions in a brand new stadium is going to be far greater than 1/3 of a cent. Okay. Far greater. Now to the property tax side of it, everybody complains about paying property taxes. And it's a sticking point for a lot of people that, you know, they have this whole eliminate property tax thing. And they got politicians or wannabe politicians that run on that premise. That is the dumbest premise I've ever heard in my life. And it's because people don't understand what property taxes are. They think it's to fund the schools. That's not entirely true. They think it's to do. The state of Texas generates $50 billion a year in revenue off property tax. $50 billion.
That's it.
They generate a little more than 50 billion. They generate over $25 billion a year in sales tax. That's $75 billion a year that they generate. That's supposed to go towards infrastructure, education, things like that. Well, the problem is if you eliminate property tax, you've got to make up that $50 billion somewhere.
Mhm.
So you're going to put it on top of sales tax because now you've just more than doubled sales tax. So now your gallon of milk is from $4 to $8 or $7.25. If I'm looking at this from a perspective of a consumer, I'm going to say that dude that's worth $10 million and me that's not worth $10 million, we
Mhm.
should not be paying
Same.
the same taxes across the board because that's what they'll be doing. They're paying the same for milk as I am, but they live in a big ass house on 7 acres. No, pay your fair share. And look, this is, I know what I'm going to get, you liberal. No, it's not liberal or conservative. It's common sense. You got to be able to fix your roads. Do they do a good enough job fixing the roads? No. We've been in San Antonio most of our lives, and we know that they're still working on highways that were still worked on when I was born. But that's where that money's supposed to go. That's what that money is generated for. It's generated to go towards schools. Do they put enough money in the schools? No. We need to run our money better, but you eliminate property taxes, you kill every class under the high class, every class. So it's not logical. And then you get people that want to protest their taxes and look at like, okay, my house, I'll give you an example. I had a guy call me the other day He has a house in Wilson County. And Wilson County is notorious for the way they assess their property taxes. I don't like it. I've fought them on it. I've won different situations with protests, several. I did over 200 protests over the last 3 years. Ridiculous amount of time to consume to do that. And I did it for free because
You starting to
what-
sound like a liberal yourself with all the protest.
oh wow, activist class. No, so in protesting these taxes, people want to call and they want to say, "Well, they have me assessed at $300,000." Okay, I go look at the property and it's worth like 580. I'm like, do you really want to protest this? Like, what are we trying to get down to? Well, my house isn't worth that. All right, cool. I'll cut you a check for that house right now for what it's assessed at. Well, no, why not? Well, it's worth more than that on the open market. That's what they're assessing. They're trying to assess it at the open market, but people don't understand that Texas is a non-disclosure state.
Mhm.
So non-disclosure meaning we do not have to disclose what we buy our property for to our appraisal district so that they don't know what closed sales are. So a lot of times they come in too high, you can protest them down. A lot of times they come in too low, and that's what you want.
Yeah.
But the minute you protest, you put a red flag on yourself. Like, okay, you protested last year. They're going to look at it again. And you got to look at it in terms of the appreciation 7, 8, 9% year over year is what your property should go up every single year. That's why you buy real estate. That's why you buy land because you want to make money off it.
Would you say that a tax appraisal was like an equivalent level with like Zillow or a
Hell
Zestimate?
no, not even
Uh,
close.
How are I know a lot of people look at Zestimates like, hey, Zestimate is this. I get those calls all the time. I know that you know more about this than probably me. How does Zillow determine that Zestimate?
Geographical comps. They pull geographical comps. They don't do it like realtors. They do it just a general area. They don't take into consideration square footage. They don't take consideration condition necessarily, unless that area is already a negative condition.
So my house can be completely renovated next to one that's same house, but
And
20
Zestimate
years
may have
old.
you at $87,000 when it's worth $250,000.
Okay.
Or you could have a completely rundown house in a neighborhood with a nothing. This happens all the time. Nothing but badass houses, and Zillow has you at 400,000. So you call your realtor, and you're
Yeah.
like,
Hey, how about
dude, you're worth 125,000. Bullshit. Zillow said, we love you, Zillow. We do love you. We're a great partnership. We do love you. But that's bullshit. It is.
Yeah.
Because as a realtor, we have to take in a geographical area that's much tighter. We have to take in comparables, legitimate comparables. Plus, we have closing information. We can access closing numbers where Zillow cannot because it's a
That's
non-disclosure
why I was bringing
state.
that up because they can't see that information either.
Mm-mm.
So they're just going based off of like, hey, these houses are here a couple years ago. I think it was them that started kind of raising the comps in the area and didn't work out and
Yeah.
kind of got sued a little bit. But we won't talk about that.
We'll leave that one for another one. But that's where it's tough. You know, your property taxes go towards so much more than what people want to think about, like getting stadiums. You know, you look at, I grew up in South Dallas or Irving area, and you look at,
I didn't know. I know Lavernia is South, but you
No.
call that South Dallas?
oh my God, you look at AT&T Stadium, Cowboy Stadium in Dallas, in Arlington. You know, it was the old Texas Stadium in Irving, and when they tore that building down, it destroyed property values.
Really?
I mean, it killed it because it was a tourist area.
That's
I mean,
true.
now you go into Arlington, which if you know anything about Dallas, Arlington was not a great place to live. Like it wasn't very nice. Like there was some parts that was okay, but it was not. Now, some of these rundown shanties that they've remodeled are Airbnbs now getting $30,000, $40,000 a quarter because all the events at the 18 or the Cowboy Stadium, the events at the ballpark in Arlington, which is now called Globe Life Field. I mean, those type of things help you. Like they really do help you appreciate. They help you bring jobs, boost your economy. Like,
Well, even these houses I see downtown here by the Alamo Dome or by the Frost Bank Center, is it right? Frost Bank Center.
I think it's called Frost Bank Center now. Yeah.
Like rundown home, literally 50, 60 years old, 350,000. You're like, what the heck?
And you remodel it, you're talking $700,000.
Yeah.
But that's why, like the Pearl, that's what they did. What they did at the
Yeah.
Pearl. I mean, a developer came in and said, "Okay, we're close to downtown. We're close to the Alamo Dome. We're relatively close to the Frost Bank Center. This is a perfect spot." Redid the entire thing, the Hotel Emma. Like they turned it into a gold mine. I mean,
Yeah.
if you lived anywhere in that area, like, I've had clients. We've done flips out there, and we'll come in there and they're like, "Yeah, we want to jump. What do you want to give? Oh, I can get like 50,000." And I'm like, oh shit. Now the ethical side of me has to come and say, well, look, it's worth a lot more than that. So, and we'll like,
in my pocket. Here
we
you
bought
go.
one for like $165,000, which was $100,000 more than she wanted. And she's like, what? I was like, yeah, I was like, give her the option. You know, you can rehab it yourself. We can set you up on an FHA 203B loan, or we can get you a cash out refinance, and then you can sell it for this, or we can buy it for this. Buy it for that. Like, I'm out. Because they want to get away from that hustle and
Yeah.
bustle too. So the property tax thing is such a touchy subject because you get so many people that are far that way. That just, you know, small government. And I want small government too, but property taxes is a necessity if you want good thoroughfares, because the same people bitching about property taxes are the same ones writing their freaking county commissioner saying, County Road 317 got a pothole. You need to go fix it. Well, who the hell do you think pays for that? Property taxes. Hospitals, taxing entities, hospitals. How do you think hospitals are funded? Property tax dollars.
We pay for it all.
Yeah, I mean, it's you gotta give a little to get a little, and that's the taxation is theft thing. It's just, it's stupid. It wouldn't be a big issue if the government knew how to run some damn money. Like, if I could budget the federal government, shit, we'd be, well, I'm probably not the best one to do that. I would be a terrible fit for that. That's why I don't run for elected offices. But does that make sense? Like, have you ever done a property protest?
I've never done one through the process. I've helped people with their comps for a protest, but I've never actually gone through the process of doing the protest. I know you could do it online or
Depending on the county.
but here in Bear County, you could do
But
it
yeah,
online,
absolutely.
right? I've never actually went through the process. Do you submit a form and just use your proof? Like, hey, this is why I believe it is the way it is. And I think today is the last day you can actually do it.
Today.
Right?
Yeah, May 15th, right?
Yeah.
Yeah, May 15th.
So every year is May 15th, right?
Every year. Unless it falls on a Saturday, probably they may change it, but they're stupid. They probably don't.
Right.
Sunday, sorry guys, you're screwed.
And how long does it normally take? Like, once you protest, so for example, if I send in my paperwork today, how long would before I get an answer?
Well, it's not that simple. So, have you done a protest before?
Yep. Just submitted mine 2 weeks ago.
Yeah. So you submit it, and then you go before a panel. So you, like, Wilson County is different. Wilson, it's probably about the same everywhere. So Wilson County, you essentially, it's almost like clockwork. You send in your protest, your right to protest or whatever, and they'll automatically send you like a settlement offer. And it's like, no, but I know what you're doing now. Like,
here's $2.
Yeah. So like, I typically tell everybody, decline your settlement offer, and then you'll decline it. They'll set a hearing date, and you have two choices. You can go before an appraiser, or you can go before an ARB. I've found recently that going for the appraiser is much easier because the ARB are volunteers from the community that know nothing about property. They don't know shit about assessing values. And I've met some really good ones there's a realtor down there that does it, and she's amazing. And she listens to the consumers. I think she's more friendly towards property owners because, you know, the whole property rights thing. But nobody knows their property better than the person that lives there. So what we'll try to do is we'll look at two different facets of protesting. We'll look at condition, property condition, house condition. Also, we'll look at actual comps, like what are sales going for? And it's a slippery slope because you have to be very careful not to disclose too much information because it's a non-disclosure state.
Yeah.
But when we go, I like to talk to the appraiser first. And if I can't come up with an agreement with the appraiser, then we'll go before the ARB. But typically you'll present your comps, and like more often than not, it's a matter of values closing in the area over the last, say, 12 months. Because if you're going on condition, it's tough because every neighbor, so you have, when you're assessing property taxes, you have land tables. Okay. So they do property taxes in mass. It's a land table. So like more often than not, a subdivision is its own land table. Where it gets tricky is these communities with these fee developers where there's like 3 or 4 different builders in the same neighborhood and they're different product lines. So like if you have a David Weekley across the street and a Highland across the street, well, they're going to be assessed the same. So it's going to be like, oh shit, which one's the appraiser going to lean towards? Is this more Highland or more David Weekley? But in general, like using Lavernia as an example, there's 17 neighborhoods around Lavernia, and every one of them is pretty similar to the other one. They're 22,000 square foot to 2,500 square foot for the most part, custom spec homes. So like Legacy Ranch is its own land table, and they're going to try to assess you to Legacy Ranch. The problem is, depends on how the weight falls. Are they comparing you to an older home or a newer home? Because if you're comparing you to a newer home and you're an older home, you're gonna be like, hey, wait a minute, I don't have granite, I don't have tile, I don't have, you know, a pool or a shop. Like, so those are things you have to adjust for in your comps, almost as if it's kind of the reverse thinking of a listing appointment. Listing appointment, you're trying to see how high you can sell it. Protest, you're trying to see how far you can drive the price down.
Yeah.
But it's just trying to be fair in the marketplace. And I think that's where people just, they don't want to be fair. They just want the cheapest. But when they go to sell it, they want
The most.
a
Yeah.
million. So you'll go before that board. Once the board makes a decision, it's on the spot. It's done right there. They adjust it on the computer right there with you. And it's submitted, and then you'll get a letter in the mail a couple weeks later saying what your new number is. You'll already know what your new number is, but they'll send it officially, and then they'll update the tax rolls to reflect it.
I thought I just called Tillman and he does it.
Or you can call, good spot. Call Tillman Davis. I don't know his number off the top of my head, but if you message us, we'll get you that number. He does property tax protesting. I don't do it anymore just because it's so time consuming. There's certain people that I will do it for, but it is very time consuming. And you're talking about taking a full day pretty much to do comps, go to the hearing, meet, and then you have to sign some paperwork, with your license number and everything. It's like,
It's kind of like you're going to court in a sense.
very much like
Not
going
that
to
I've ever
court.
been, but it's kind of like that.
It's very much like that. And it's pretty stressful, especially for the consumer, because they're freaking out. Like, I've got people that get assessed twice what it's worth. And they're like, you start to ask yourself, how can I afford to live here? And a lot of people are selling now because they can't afford to pay property taxes. I mean, I get it. And I wish there was a flat rate, just a flat tax,
Yeah.
whether it's, 1% of the value. That's a fair number. $1 million house, $10,000 a year. A $500,000 house, $5,000 a year. That's a fair way to assess it. I'm not sure why they don't do it that way. It makes sense to me, but I think it's because there's so many different entities that get a certain
Yeah.
percentage. It's just hard to kind of, and I don't care how you figure it out. That's how it should be, because you as the federal government should figure out, okay, well, this entity's wants to get this percent, this one wants to get, they're all proposing this percentage. All right, cool. $5,000. You get 0.7%, you get 1.3%, you get 2.5%. That's your problem, not mine. Flat tax it, be done, move on down the road, adjust value at market appreciation rates. So that your house isn't going to go up $100,000 the next year. It's going to go up on average 7%.
Obviously, I've come across some properties that have been in 2 different counties and paid 2 different taxes. When you lived over in Overlook Parkway, was it like that your home?
No, so we just missed the cutoff.
Okay, because
we were still in Bear, but we were literally like,
I had somebody who's paying
Comal.
Bayer and
Comal, yeah.
Comal, and I was like,
both.
I don't know. I didn't know what to say.
It's tough. I don't even know how that works. I'm guessing whatever you corner, if you don't have improvements, it's just land that I'm not sure. We've done some farm stuff like that, but it's completely different. I mean, you're basically taxing it as a separate parcel.
And I always say to check too, because last year I actually had a client who he new construction home, and they do new construction, I guess, a little different when it's not completely built. And they had his home at like 6,000 square feet when it was only 3,600.
Yeah.
So his tax appraisal was like 1.5 million, and the actual home appraisal was only 1.2.
Did he have like a big patio or something?
I think it was he had a rooftop, like a patio overlooking, and that's what they said. They came over and looked over the top.
So that's where you kind of get in trouble with so you're supposed to, so they can come on your property unless you tell them otherwise. You don't have to let them in, but that's kind of what you run into, because they'll do an aerial and they'll just map the roof.
That's exactly what they did.
I was just looking at a video that I posted on social media, I guess it was yesterday, about one of my builders. They had like 600 square foot more than we actually built.
And I actually called Tillman about this, because it was in Bernie, and he kind of told me that a lot of times what they'll do, since it's not finished, they'll do the aerial and put a placeholder. We're all human. If they don't come back and change that placeholder, now you got a 6,000 square foot home, and if you don't look at it, you're just paying. It can go on. Luckily, this was like 6 months. The builder was actually one that lived there. He didn't look at it himself. I'm like, but
send the plans in.
Yeah, but we Tillman actually ended up helping, and we got it corrected before we closed and everything. So
we fought this guy at the appraisal district. Oh my God, he was it wasn't a very nice gentleman, and he was the big culprit that screwed up so much in 2021 when I first started this whole protest process. It was so bad. Like, I went to I couldn't even tell you, double digit of protests, and won every single one of them by a large margin, because he was just missing things like comparing the properties against the wrong properties and over assessing land. But then the one next door that got assessed was under assessed. It's like, what are you looking at? Figured out that there was some sort of an error in how they were calculating it. Went back and did a bunch of corrections. And then last year, I think it was last year, the year before, one of my builders built his own house. and they put like 600 square foot more on the house. So he got his thing. He's like, Chris, what the hell? I was like, send him the plans. Easy solution.
Yeah.
The plans will show you what is your living square footage. That's what they're taxing you on, living square footage. And he sends the plans. He's like, no, our square footage is right. And he's like, he calls me, he's like, what do I do? I was like, I'm gonna call him. So I called up there. I was like, are you really gonna argue with engineered build plans? Like, well, he overbuilt. I'm like, yes, because the builder added 600 square foot to his house without plans. Like, yes, because that's normal. What are you talking about? Not only is it in the city limits, so it's permitted and it has to be engineered and that has to be submitted to the city. That's the stupidest thing I've ever heard. Like, what are you talking about? Needless to say, he doesn't work there anymore. Thank God. But pay attention to your square footage because that's
now.
no, he actually works for an appraisal district in some small county south of San Antonio.
Wilson.
No, that was where he was at. But he was a joke. But square footage is something that people miss a lot because some people just don't know what their square footage is. Like, pay attention to that because 100 square foot, that's a lot of money.
Yeah.
Good price per square foot. Let's just say it's $250 a square foot. What's that? $25,000. It's $25,000 more than what it should have been.
Especially like on some of these huge homes that are 5,000 square foot, add another 1,000 square feet. I mean, that's going to be expensive.
Well, the other big thing you see, and I know you see a lot, is people forget to put their exemptions on their properties. Homestead exemptions. Jesus Christ. As a
What's that?
realtor, you would be one that guy forgot to tell him. Like, but as a realtor, you should tell him the minute you close, go get your homestead exemption. It's no longer retroactive. It's now instant. So like people are telling you, somebody posted on Facebook the other day that, oh, they couldn't get it because it's after January 1st. Bullshit. That changed what, last year, 2 years ago?
2 years ago.
Yeah. The day you move in, it starts. Apply for your homestead exemption. It doesn't matter if it's January 1st. It used to be you have to have lived in it January 1st to get the exemption. Not no more. Veteran exemptions, disabled veteran exemptions start at 10%. You're 10% disabled, you get a variance, an adjustment to your value. At 100%, obviously, you don't pay property tax. If you got a problem with that, kiss my ass. I don't care. They deserve it.
If you're old, like 65.
65 and up.
Yeah.
Why are you pointing at me?
Don't you get that?
No.
Next month, you'll get it?
I'll be 40 and it's 2
okay.
months. But no, disabled veteran exemptions, 65 and up freezes your school taxes. Pay attention to those exemptions. It's really important. And if you're an agent listening to this, make that a part of your script, especially when you're doing your buyer's representations. Line that out so they understand through the process. We're going to save you some money on your property taxes. It's also a good way to stay in touch with your clients.
Yeah, 100%.
Hey, you want me to protest your property taxes for you or help you protest them? Let me walk you through the process. Or here's Tillman's number. That's what I do. I just give him Tillman's number.
Right. Yeah, that's what I would do too.
Well, I think we've covered a lot of ground, a lot of mortgage stuff. Tell us how people can find you, your socials. You're a celebrity. Are you on YouTube and like that?
You'd be at the Roost or.
Oh, dude. Okay. All right. We got to talk about it. Okay. So if you live in the Fair Oaks area, there's this new bar. Have you ever been to Conroy's? Everybody that lives in the Fair Oaks area knows what Conroy's is. So a buddy of ours, Jason Bridgman, I've talked about it on this podcast before. He opened a bar called The Roost, and we went there last night. That place is flipping awesome. Dude, like legit. Like that place was cool as hell. He remodeled it. It's super bright and airy. I think you can be in the minor up until 10 o'clock. After 10 o'clock, it's 21 and up. The nachos. Yeah, it's because it's a restaurant.
Yeah.
It's a bar and grill. And the food, like we had the nachos. I had the beef nachos. Holy shit. They were amazing. Like now Cadence, his daughter, she got him first. And I was like, oh man, they don't put enough cheese on them. Because I want to smother that son of a bitch with cheese. Dude, they smothered it. It was so good. And then they're doing tap beer. This should be in the next couple of days, 27 degrees.
Right.
I wish it wasn't so far from my house. That's a run, bro.
A little
That's
bit.
a run.
It's not too far from me.
It was
20
good.
minutes.
You gotta go.
I think we're going Friday.
I'm gonna get a bunch of the BRC guys, donut operator, all those guys to go out there with me next week. They were out there 2 days ago and they kick ass spots right around the corner from their podcast house. Like check out the Unsubscribe podcast if you haven't. It's called Unsubscribe. Like it's a badass podcast. But no, they have a podcast house. Like, see, we have this little ass table in this back office that I'm pretty sure doesn't have air conditioning because it's hot as
It's always hot.
ass in here. But they have a full ass 2-story, like 4,000 square foot podcast
Just for
house
podcasts?
just for
Dang.
podcasts. I'm like, that guy that owns that house is loving it because he's like, nobody's living there. All they do is record podcasts there, and they're going to be there forever. I mean, they've got
Let's go
like a
find a house to
million.
rent out.
No, we're not there yet. We need like, I don't know, 1.8 million 1.2 more million followers. I think we got 6 on YouTube.
That's good.
Yeah,
6
we
is
gotta-
not bad.
we're gonna
That's
have
more
to-
than we had last month.
We should buy some subscribers.
Okay.
We need your friends to subscribe, Josh. You know a lot of
we'll have
friends.
to get them to
So
subscribe.
again,
No,
how
I
do
know.
people find you?
Yeah, no, I'm not a big social media. I mean, that's probably the one thing I'm the worst at. But yeah, I mean, I'm on social media. Borrowfromjosh.com is the website. So if you guys have any questions, any information as far as our programs or anything with mortgage related, again, you can find me personally on Facebook, or you can go to the website and inquire. So
I'm sure we'll have his phone number like here or over here.
I didn't do that last time.
Yeah, you did. You left me hanging on that one.
all right, make sure you-
Asshole.
We'll get it this time.
Yeah. So borrowfromjosh.com, Josh Martinez, Homeward Mortgage. Really appreciate you coming on. Definitely need to do it again. I want to do it on the hard money side because we need to talk about Wind River. We need to talk about the options for investors. That's a hell of a program. If you want to get into the flipping side of the industry, I use them with my clients. Killer so far. I think we've done 1 or 2 deals already. Got another 2 more we're looking at. So it's a pretty badass little program. We'll leave your flip alone.
Great flip.
Anyways, for Carlos Kopszywa, I am Chris Jacobs. We appreciate y'all tuning in, and we can't wait to see y'all again in a couple weeks.
See you later.